Good afternoon, everyone. I'm Stacy Scott, Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm hosting today's webinar. We appreciate you joining us today, and this is our last Lunch and Learn of 2021. So we hope you enjoy today's session and that you are able to glean some valuable information that you can use as we prepare to go into 2022. This month's Lunch and Learn features Graham Wickham, President and CEO of Wickham Financial and Insurance Services. And he's going to share some information on how to maximize benefits and minimize taxes. Throughout today's session, if you have any questions for Graham, please type them into the Q&A section of our chat box, so he'll be able to address those during the question and answer session at the end. And as always, you'll see Graham's calendar pop up periodically during the presentation. So if you'd like to schedule some time to talk with him, please click on that calendar, and when it pops up, select the time and day that work best for you. And now, without further ado, I'll turn things over to Graham.
Hey, thank you, Stacy. Thanks to everyone that's on the call. Can we believe it's Christmas already? It just blows my mind. So hopefully everyone that's in our audience today has gotten your presents. You're not in the middle of the rat race, which I will be, because I still have to get some last minute presents. But thank you all for being on the call. As Stacy said, this will wrap it up for the year, and we're really a week early. If you noticed via the email that went out, because we wanted to give everyone time to take advantage of some end of the year planning to maximize some benefits for yourselves and minimize taxes. All right, so we're just going to go through different steps. Many of you have already taken this when we get into contributions to retirement accounts and whatnot. Some of this might be brand new, and you might want to think about or talk to us about what steps you need to take to go ahead and get those deductions, get those contributions in, so on and so forth as we go through today. But let's think about it. A lot of these are going to have end of the year deadlines to them. Some are going to have April 15th. We're not going to go into the full details of every single one of these, but I'll kind of talk through them a little bit. And then when we get to the end of the Lunch and Learn today, last 5-10 minutes, hopefully we'll have some time. We'll just cover some Q&A. Maybe I can add additional flavor on that. Always reach out to me or anyone in my team if you have additional questions on anything that we cover during these Lunch and Learn sessions. We can always add much more details or meet in person on that. All right, so let's go ahead and kind of jump through. So just kind of running down the list. First off, I'm going to get to the first slide, and then Stacy, I wonder if we maybe missed out on one side. No, we're fine. Did you adopt a child this year? All right. So maybe some of you did, maybe some of you didn't. Some of our retirees, I probably don't think you did. But if you did, think about it. You can take a distribution from your retirement account without penalty to help cover some of those expenses. We want to think about taking advantage of our Savers Credit if you're eligible. So Savers Credit is a non-refundable federal income tax credit available to individuals with adjusted gross income of less than $66,021. One other item is charitable contributions. I don't know if y'all do this, but it's popular in my household. We pack up the car, we go through the house, we grab the jackets, the less used shoes, if you might, or goods, and we'll take them down to our local charity or qualified organization, and we'll make those contributions. So if you can take a deduction for that, pile up the car. We do it as a company here every year, as well as personally. Make sure you get those in by the end of the year for those charitable contributions. Then let's look at fully fund your employer sponsor plan. Now, I think this is sometimes overlooked. A lot of times we put our retirement plans on autopilot, right? Your 401k, say take X number of dollars out of my 401k, or take a percentage out of my paycheck if you're paid once a month or bi-weekly, and it comes out. But keep in mind, you might be underfunding that, because if you're under 50 years old, you can put $19,500 into that in your 401k. your 403B, your 457, your TSP, all right? If you're over 50 years old, then we have what's called a catch-up provision. You can put additional 6,500, all right, get you up to 26 and change. So you want to think about, am I maxing it out? Did I get a pay raise so I can put a little extra in? Did I get a bonus that maybe I can slide over there? So how can we get more in? Why would that be advantageous? Well, if it's going into a traditional deductible format, you're gonna lower your income that you're gonna claim to the IRS next year. All right, for this year. All right, so you're gonna show less income. You're gonna put more away for you, working for you tax efficiently. If you're making the Roth contribution within the 401k, well, you won't be able to take the deduction, but keep in mind, it's going to grow tax-free for you. And over time, you can probably just imagine, if you already have Roth accounts or you're participating in Roth accounts, imagine now down the road, you never have to pay tax on it. So it's a great benefit for down the road. If we look at let me expand my screen here. If we look at funding IRA accounts, all right. So you can, let's put it this way. If you're not funding an employer-sponsored plan through your employer, you can fund an IRA, right, and have a deduction. But if you're funding your employer-sponsored plan, you might not be able to take the deduction on the IRA, right? But also keep in mind, I'm going to give you another twist to this. If you have an opportunity to fund a Roth account, meaning your income allows you, because your income level is below the limits, and you can fund a Roth account, you can fund a employer-sponsored plan and fund a Roth in that situation. You just don't get a deduction on the Roth, but you never get a deduction on the Roth. But keep in mind, it grows tax-free. So let me go back. So if your income allows, you can fund a 401k through your employer and fund a Roth on the outside and be able to make that contribution. The other way to think about it is that maybe you can fund a IRA and your employer-sponsored plan, but it might not be deductible. And if it's not deductible, just want to make sure when we get into filing some certain forms in a minute, we're just going to remind you to do so. All right. So your contribution limits to your IRAs, your Roth accounts, there's going to be 6,000 or 7,000, depending on your age, under 50, over 50, and those income levels. All right. Then fully fund your simple plan. So in 2021, so generally simple plans are going to be for employers, or if you're an employee of a company that doesn't have a 401k, maybe it's a smaller company, they open up a simple. In 2021, you can defer a maximum of $13,500 into your simple IRA. Participants age 50 plus, again, they get that catch-up provision of $3,000 for a total of $16,500. But look at these numbers. You have an opportunity to fund more into a 401k, right? 26 and change compared to $16,500 with the catch-up provision in a simple. So this might be something for next year. If you're working at a company, it's a smaller company, maybe you want to put a bug in the ear. If you want to try to save more and you want deduction for it, maybe they move to a 401k instead of a simple, but at least take advantage of the simple contributions that you can have for that 2021. You want to think about contributing to a Roth account for a child, often underappreciated and overlooked. There's not an age limit on this. They just have to have earned income that you file taxes on. And keep in mind, the child is probably going to make a small amount of income, maybe just the amount of the contribution, all right? But it has to be filed, and the contribution cannot exceed what they earned. And again, $6,000 is a contribution level for that. So it might be another way to get tax-efficient money in, tax-free down the road for the child. If they hold it for 5 years from the first contribution and they're over 59 and a half, so I know it's a long time to think about it for a child's Roth account, but they can also use it for first-time home buyer and won't receive a penalty. They can also use it for qualified education expenses, I think medical expenses. So there's other ways that you could get some tax efficient money into plans for the children while they're still very young. If we just show some income and you file taxes on that. And the one interesting thing is the Backdoor Roth. The Backdoor Roth didn't get kicked out this year. We'll see what happens going forward. But listen, if you're in a high income level and you can't make contributions to a Roth because your income's too high, then you can consider a backdoor Roth. A backdoor Roth is opening up an IRA account, funding the IRA account, and immediately converting those dollars over to a Roth. All right. So when we get, and I'll probably bring this up again, when we think about positioning assets, at least here from a wealth management standpoint, in tax strategies, we want to think about putting as much money on your side and being picky, right? We want to think about not paying taxes on something as long as we can because we get that tax-free or tax-deferred compound effect, right? So we want to think about 3 buckets. Tax now would be like your brokerage account. You get a 1099 at the end of the year or the following year that says whatever you earned and the gains, losses, so on and so forth. So that's tax now, right? Or taxed later. Tax later is going to be any of your retirement accounts, like an IRA, 401k, 403b, 457, the like, but not Roth 401ks, etc. All right, because they're not taxed if you meet 5 years and 59 and a half rules and regulations. So that's taxed later. And then we get into the last bucket. So 3 buckets. The last bucket is never taxed. So we want to think about never taxed as Roth contributions, right? Municipal bond income, not capital gain, but income, all right, in your brokerage accounts, never municipal bonds in your retirement accounts. It negates the tax-free benefit. And then we think about cash value life insurance can be one. Oftentimes called a rich man's Roth. The way that you want to consider that is overfunding a life insurance policy. Don't lapse it. Pull cash out to help fund whatever goal, objective, retirement, whatever your need might be, but done properly, you don't pay any tax on it. So again, just a term in our industry, rich man's Roth. Okay, just thoughts to consider when, and if you're a client of ours, or if you just don't remember, we're always talking about positioning assets in 3 different buckets because we don't know exactly where taxes are going to be, where credits, exemptions are going to be for you. And it looks like right now, taxes aren't really going to be lower. They're probably going to be with us and going higher, as well as exemptions and credits are probably going to be lowered or dissipate in some areas. All right, we just don't have all the facts on all that right now. So let's see about overfunding your IRAs. Did you overfund it? Is what we're talking about. All right. So if you overfunded your IRA, and it's a common occurrence, you can easily do it. Because think about it. All right, I make this income and I'm putting in this contribution, but no, I've overfunded. You got to back it back out, right? Or there's a 6% penalty for every year the excess remains in the IRA. So we want to think about making sure we withdraw any excess contributions to an IRA by the deadline so we don't have those penalties going forward. If we look at, check and see if you've made non-deductible or after-tax IRA contributions, all right? So if you did, you want to make sure your modified adjusted gross income qualifies. You want to make sure that you have a Form 8606 completed because it's a non-deductible transaction. If you're already funding an employer plan, doesn't mean you can't put it in there. You can. You get tax-deferred benefit, but when you pull it out down the road, all right, let's say it's your retirement and you're starting to take, let's say, RMD distributions. We'll talk about that in a minute. Or you're just taking distributions out of your IRA and you're past 59 and a half. Anything that comes out of an IRA, 401k, 403b, 457, simple as the like, that's going to be taxed to you as income. But keep in mind, anything that was coming out as a Roth account, Roth 401k, so on and so forth, well, meeting certain qualifications, that'll come out tax-free. But it's just something to keep in mind that if you're making non-deductible contributions, I'm not going to tell you not to do it. Make sure you file the forms. Your CPA will probably be filing the forms. Always check behind. Make sure that's done. All right. If we look at and we just continue with non-deductible, find the 8606 on that. Determine if making a Roth IRA conversion in 21 is the right move. There's been some real debate, and I mentioned it here, that, maybe taxes are going to go up for certain income levels, so on and so forth. So So maybe I convert my IRA today to a Roth so I have tax-free benefits down the road. If you think that you're going to be in a much higher tax bracket down the road, maybe it makes sense to have some stuff tax-free instead of taxable down the road. Keep in mind that everything that you're going to have at some point in your retirement is probably going to be taxed in one of those three buckets, or at least we want to try to think about those three buckets. So if you have Social Security, all right, you're receiving Social Security benefits. Up to 85% of that Social Security benefits is going to be taxed, potentially depending on the income that you make, right? Then any pension that you receive, all right, is going to be taxed as income. Then let's say any distributions from your retirement accounts, not including Roths and the like, they're all going to be taxed because anything that come out of those plans are taxed as income. And yeah, anything else that's going on in your life as a side job or a part-time or consulting, whatever it might be, full-time still, that's going to be taxed. So if we look at it, it does make sense, right, to start thinking about how can we create things that aren't going to be taxed compared to right now, mostly everything's going to be taxed. Now, for the young individuals who are on the call, 30 below, 40 below, I don't know exactly where everything is. It's not possible to know. That's why we create the three buckets, since we don't know exactly where it's going to be. But I love the idea of my younger clients, even my older clients, 60 plus. It's still a case to make these Roth contributions and consider IRA conversions. One other thing, and not to beat this horse too much, think about a Roth isn't just creating tax-free benefits for you down the road, but if it is a goal and objective to lower the burden of taxes for your heirs or the ones you care about who you're passing assets on, that can be a very tax efficient way of doing that from a tax planning or estate planning standpoint. So again, another layer of the wealth management that we often talk about that you need to have a part of your big picture planning. It's not just about the stock and bond and ETF and mutual fund you're buying. It's not just sometimes the IRA or Roth or retirement account at work. You got to think about why you're doing something and kind of extrapolate, what does it mean to me or the ones and the things I care about down the road, and how much do I want them to be burdened if that's a concern of yours, right? So think about doing IRA to Roth contributions in 21, and does it make sense for you? All right. One other item I don't think was kicked out is the Mega Roth. All right. The Mega Roth, you might be looking at your employer sponsored plan that was originally deductible in the traditional 401k or the like. Now convert that over to, or a large portion of that convert to a Roth. You don't have to do all this in 1 year. Let's say you got a $100,000 IRA hanging out there and you're like, yeah, I want to convert that over Roth, but I want to look at my marginal tax rate and see, okay, where is it going to hit me, or where would it might bump me up in taxes? So maybe I'll only do $10,000 a year, or maybe I'll do $25,000 or $50,000. So you're not obligated to do the whole thing. Just keep in mind, when you convert, you have to pay taxes on the money you convert in the year that you convert. Okay, so just food for thought as we go through the Roth benefits. Review your age and what are your eligibility and what are you required to do. Now we're talking about RMDs, and we're in the RMD season right now. For many of you on the call and many of our clients, you're at that stage of life that you have to take out, or you're approaching that you're going to have to take out RMD distributions. Now in 2020, you did not. They waived the RMD distributions, but they brought them back on in 2021 because of the pandemic to give some relief. If you didn't need to take it, they didn't want you to take it, all right? But now you do. It's 72, used to be 70 and a half. You have to. And you have to take it out by year end to avoid a 50% penalty. It's absolutely no reason. Now you might say, I'm turning 72 this year. Do I have to take it out this year? And actually, if it's the year that you're turning 72, you can wait till next year, all right, by April 1st. But keep in mind, you're going to have double payments coming out to you if you do that. And from a tax standpoint, that might not be advantageous. So just make sure you run the numbers. Just because we're a little short on time, look at your planning or how you're using net unrealized appreciation. That's if you have stock from the company that you work with. Ensure that your beneficiary designations are in order. really important. Let's keep in mind, have you had something that happened in your life? Like a divorce, a death of a loved one, a spouse, a child. Has something happened in your life that says you need to change the beneficiaries? Meaning, who is it going to be passed to? Because anything in your retirement accounts, your 401ks, the IRAs, Roths, and even annuities, you're setting up benefactors. Who is going to receive the assets first, and who's going to be the co-benefactor, after them, so on and so forth, right? And just also be careful. You do want to name that. It bypasses probate, expedites the estate planning or distribution process, alleviates expenses, potential time held up in courts, especially since we've gone through the COVID period. We've seen some things where their attorneys kind of held up. But one thing you want to keep in mind, if you're naming children as benefactors and they're not the age of majority, meaning they're not, let's say, adults, they cannot receive assets. If they can't receive assets, you need to do some additional planning, all right? Because probate would step in to manage those assets for them, or set up an executor of the estate, or a custodian, if you might, to do that for them. So just keep in mind, for minor children, it might be a couple extra steps you want to take. Going through and making sure I stay on track here. If you inherited an IRA in 21, be aware of the payouts. Inherited IRAs, we used to call stretch, right? You could take out the minimum, the R&D, required minimum distribution, and stretch it out over time. We can't do that anymore. You got to take them out over 10 years. All right, so keep in mind, you don't have to take it out all within the first year or second. You can wait till the 10th year and take it all out in 1 year, but you might want to stretch it out over time to mitigate taxes. Review your qualified charitable distributions, your QCDs from your IRA. You can make qualified contributions to charitable organizations. Make sure you're doing that so you get the deduction and so on and so forth. All right. If you did a 60-day rollover in 21, verified it was done timely and it was completed correctly, so the IRS doesn't come back. Keep in mind that you verified that the 60-day rollover was completed. Should also confirm that only one 60-day IRA to IRA rollover per account owner was done in a 365-day period. You can only do one. That means you receive the check, not payable to the custodian, and then you turn it around and make the contribution within 60 days. You put it back into a qualified account, account. You can mitigate taxes and penalties by doing so. You can only do that once, all right? But if you have it made out to the custodian, say you retire early, you take an early payout, you change jobs, the company closes, things just don't work out, whatever it is, you receive assets from the 401k. Try to have the check paid out to the custodian, all right, to whoever you're rolling it over to. As you're a client of ours, it's TD Ameritrade. Make it out to TD Ameritrade. At the end of that, it'll say FBOU. And by doing that, you don't have any mandatory withholdings. You don't have to worry about a 60-day window. It goes right into the qualified account or the rollover account, if you might. Everything is great. All right. If you're taking substantial equal payments, 72T distributions, meaning I want to get money out of my account early, say I'm 55, right? Or 56, 57. But, I want to start retirement a little early. I want to avoid 10% penalties. Here's a way to do that. 72T distributions. When you turn 59, you can stop those payments. Or at least you won't get a 10% penalty. How about that? Consider funding a Coverdell savings account if you can. $2,000 a year if your income allows. Fund a 529 ABLE account for disabled persons can be another option. All right, some end of the year deadlines for that. Contribute to your HSA, your health savings account. You get some tax deferral for qualified healthcare services. It can be money that works for you for down the road. If you had a 2021 activity in your HSA, you need to file the correct form for Form 8889. Make sure you file the form. If you haven't talked to your CPA, they can make sure they file that form for you, or just make sure you file the HSA form, all right, on a timely basis. Let's look at distributing simple plan notifications. This is going to be more for our business owners right here. We want to make sure you distribute those out 30-day, 60-day, 90-day windows that you want to get it out to notify to your employees about the plans that are available to them if they qualify, and then they have to either accept or deny it, and then they can contribute. They have a match, or it can be just a 2% non-elective match. You can have a match of 3% or a 2% non-elective. But for any of my business owners out there that want to know more benefits of a simple compared to a 401k or a SEP plan, so on and so forth, click my calendar when it comes up. Give myself and team a call, and we'll go over that with you. Last but not least, let's open it up now, Stacy, if we can, to some Q&A. I think I'm doing a little okay on time, surprisingly.
Looks like it, sure. Okay, one of the questions that we've had come in is, do I still have time to take advantage of these deductions and contributions?
You do. Some of those, if you recall, some of those are going to be in April. Some of them are going to be by the end of the year. Just need to figure out which ones you're trying to hit. And you can call me, you can call my team members, and we can talk to you about it so we know if that's a December 31st, if that's an April 1st or April 15th deadline, or is it the deadline of when you filed extension for your taxes?
Right. Okay. And then a little bit off topic, are the markets going to be up next year?
That's a great question, right? I think the opportunity is strong that we have a decent year next year. And as anyone watches the weekly wrap up, especially this last one, I said, hey, listen, we have had 2 great years in the market. If the market is not as good, meaning it's not up 20+% like it is on the S&P right now, who knows? We're not at the end of the year, or 10% on the Russell, or 14 or 12% on the NASDAQ or Dow. If it's just up 7-8%, would that be the worst thing? Would it be the worst thing to kind of have maybe a digestion period? Should we expect a correction or a pullback? Remember, a correction is about 10%, a bear market's 20%. I always say expect a 5-10% correction anytime. So I guess long story short, I think the opportunity is there to have a reasonably good year next year. It just might not be as good as this year. We'll just have to wait and see. But that's an excellent question.
All right. We have another question. Are we going to have a Santa Claus rally this year?
Everyone loves these questions.
I know.
Well, if you got the weekly wrap up, you remember I talked about it. So Santa Claus rally is basically, of the last 45 sessions, we've had a rally of the last 34. And it's the last 5 trading days of the month and the first 2 of the previous year, or of the next year, excuse me. So that's the Santa Claus rally. Could we get it? Well, the odds are in our favor. If you look at history, I think it's traditionally a very strong period. It's a lot of window dressing going on with the portfolio managers, hedge funds, institutional traders, where they want to position assets in the accounts. Maybe they took tax losses. They want to offset their gains. Maybe they want to what's called window dress, position certain assets in the account that look very good or very in vogue, so they look great to the shareholders. That's what's done a lot during this period. So, I think the opportunity is pretty strong for that.
Okay. Well, that's sounds good, and it's a lot of information to digest this afternoon. I think everyone would agree that it's very timely information as we wrap up this year and head into 2022. And so I would like to thank you, Graham, for all of that. And also thank you to our viewers for joining us today. And every time you join us on our monthly Lunch and Learns. We also post regularly on social media, and we have our weekly wrap-ups every week, not only on social media, but also on our website. So please continue to check those out regularly for our most up-to-date information. And I hope everyone has a very happy holiday, safe, and we look forward to working with you as we go into 2022 and beyond. So thank you so much for joining us.
Stacy, great comment. And I want to give my best to everyone on the call. If you're not on the call, if you're listening to you follow up on email, or you go to our social media to get this, because we're going to send it out, right? Email, all of our social media posts.
Absolutely.
I just wish you all a very safe holiday season. We are truly blessed to have each and every one of you on the call as clients and friends. So we wish you all the best for the new year. And again, we're here throughout the year, the rest of this year, and we got a lot of good stuff looking forward to us in 2021. Excuse me, 2022. So thank you all for being on the call.
Thank you. Bye-bye.